we are going to be looking at financial statements of limited companies. Very catchy name, I know. Primarily tonight, we are going to have a bit of a flying visit. Obviously, a lot of different standards that could potentially crop up here. So it is going to be a bit of a brief recap, some of the key things to remember to do with various important standards that could come up in the exam. So we're going to have a bit of a recap there to start with. Before seeing it in some exam style context, it's primarily going to come up directly tested within tasks 4 and 5. That's not to say it can't crop up in other areas as well, but your tasks 4 and 5 are going to be built largely around your understanding of these standards. So definitely the most important questions when it comes to accounting standards. All right, we'll get straight into it. And it actually starts out with a bit of a talk here in relation to task 4. Tells you about the mark allocation here on screen. We're going to have a bit of a run through of the briefing bit here itself. While this says it relates to task 4, when we get onto the task 5 stuff in just a second, well, I'll say just a second, a bit later on in the session, it's going to be based around the same stuff. The task briefing you'll see when we get onto those tasks is basically going to say, refer back to task 4. So you can think about these two sort of being paired up as a pair of tasks that all relate to these standards. Okay. So yeah, we are going to have a bit of a flying visit here, reminder of the key points. If there is anything you would like to ask as we go along, please do feel free to throw it in the chat box. I'm not going to force you to hold questions until the end or anything like that. I'd much rather, if you've got a burning question, you throw it at me and I'll do my best to answer it as best I can. So yeah, please don't be shy. Please do feel free to throw it in there. The odds are if you've got a question, somebody else in the group will have as well. And if everybody's shy, then everybody's left it sort of in the dark with it. So I'd much rather you ask the question and clear things up. Even if that means pulling you back to something that I've moved on from, please do feel free. Okay. We're going to start out with inventories. IAS 2 for inventories. Largely, this is going to be considering how we go about valuing our inventory items. Inventory covers all sorts of weird and wonderful things that you've probably seen throughout your studies here. Everything from the raw materials that we're going to stick in a warehouse and then convert into something down the line, all the way through to those finished items that we're going to end up selling to our customers. The single most important thing that we're going to be looking at here when it comes to inventory is this rule over here. Inventory is valued at the lower of cost or net realizable value. Now, I'm hoping we can all probably work out what cost is very easily. We probably have a good understanding of what that relates to at this stage. Does anybody want to help me clear up what that term net realizable value means? It sounds very fancy and official. What would your understanding of net realizable value be if you put it into sort of simple terms here? Market value certainly comes into it there, Magda. I like it. Good start. There might be a little bit more to it than just simply the market value in itself. Current value, yeah, absolutely. A couple of people saying about selling prices less any selling costs. What you would receive, realistic price if you go to sell it. I love this. Some great stuff coming through in the chat box here. Yeah, essentially it's going to be the end benefit that you're going to get out of it as a business. That's how I tend to think about it here. So let me just let those in the waiting room in there. So yeah, those of you saying sort of a selling price less any costs involved to get you to that point that you can sell it. You know, maybe you've got an item that's sat in your warehouse. It needs a little bit of work doing to it before you can sell it at that market price that we spoke about as a starting point. So you can't just consider that final sales price because there's a cost involved to get it there. So essentially it's the extra contribution, the extra profit, you know, that extra money that you're going to get out of it as a result of getting it to that point of sale. So that would be your key thing with inventories. Another important rule you've got on the line below there that can often lead to some issues. You do generally go through this on an item by item basis. It's very easy, you know, you very commonly see this. People will take subtotals of all of the cost of all of their inventories. They'll come up with a total for the net realizable value of everything that's sat in a warehouse, compare the two totals and pick the smaller one. Good idea in theory, but you need to consider each individual item on its own merits. So you need to do that exercise for every single type of item. Okay. It's just to give you a more realistic picture of the overall thing there, the overall value of your inventory. So your accounts and your figures reflect the true picture, which is always good. Next, we have cash flows. So that we don't overstate our assets. Fantastic, Sarah. I may well come back to you when we get to the actual task here. That's a very good thing to stick into your answers. So that is a really nice way of framing that argument there. I like that a lot. So yeah, with statement of cash flows, generally this is an area that students are not too keen on. I think generally this comes from the fact that generally people will have had a lot more exposure to statement of financial position and statement of profit and loss. Statement of cash flows are generally not seen anywhere near as much. The good news is when it comes to task 4 and task 5, they're not going to be expecting you to prepare a full cash flow. It's not like you're going to have to go through that full exercise that you may in other areas of this paper. So we're not going to go into too much detail here. The main things you're going to need to consider is the idea that it gets broken down into these 3 sort of subcategories within a cash flow: operating, investing, and financing activities. And the main premise of this statement of cash flows is to sort of remove those paper figures, I always tend to call them. They're a bit woolly. They're not really costs or incomes that actually you physically have to pay as part of the business. So it doesn't affect your physical cash flow. Think about things like depreciation. You charge it on all of your fixed assets, but it's not like somebody comes around and demands that you pay a depreciation bill or anything like that. It is just a paper figure that gets lumped into your accounts there. So yeah, in terms of your realistic position, it's not really an actual expense. So that's kind of what we're trying to achieve with that statement of cash flows. As I say, tends to be just talking about specific examples, how you might treat certain things, but you're certainly not going to be expected to produce a full cash flow here. So yeah, just a bit of an understanding about what you're trying to achieve with those is all you're going to need in this section. Apologies, Nelly. No, that's absolutely fine. No worries. You should be getting a recording. So if you did miss a little bit at the start there, you'll get the full recording there. So you can fill in any gaps along the way. All right. We're going to go on to IAS 10 next. Events after the reporting period. It's one of those that kind of does what it says on the tin here. It's an event that happens after the reporting period has ended. I know, you'd never guess, would you? It falls into 2 categories: adjusting and non-adjusting. So these are your 2 key concepts that you're going to need to know a little bit about here. Your main condition for something being an adjusting event tends to be along the lines of this sort of pre-existing condition. Yeah, we are currently going through tasks 4 content here, Louise, but this is stuff that will link directly to task 5 as well. So a bit of both on that front. No worries, fantastic. Yeah, so your adjusting event, there has to be some kind of pre-existing condition. You know, it has to have been factored into your accounts before the year end for it to require adjustment due to an event that's happened afterwards. Can anybody give me some examples what would classify as an adjusting event that you may have come across in your studies up to this point? Anything we can think of? Customer going bankrupt. Yeah, Sarah, Linda, both going for that one is a very common example. Fire, yeah, maybe a load of our stock gets destroyed. That's actually going to link up to this point that we've got down here about going concern. If it's significant enough to make us worry that the business is going to survive, we absolutely need to be putting something in the accounts to reflect that. Being sued, court outcomes, yeah, any sort of damages or settlements. You know, ongoing cases tend to be the big thing there. If it's up and running before the year end and you get some more information afterwards that's going to help you update that position in the accounts, you're going to need to update it for that information that's come to light. Provisions turning into liabilities, yeah, that would be a perfect example of something like that as well. Accruals could potentially crop up. Yeah, maybe there's something that got missed in the accounts that we need to bring in, should be reflected in there. Holding stock which is unsaleable, not fit for purpose. Yeah, so maybe we got a big valuation on some stock that turns out is actually obsolete. So it goes back to what we've just been talking about in terms of this inventory valuation, and it's not giving that true position. We're overstating, so we need to rein it back in a bit. Yeah, I like that a lot. Inventory item now illegal to sell. Yeah, and there was a big thing with Tesco's, I know, probably the wrong time of year to be bringing this up, but I think it was Halloween costumes. And there was all sorts of fire safety issues with it. So basically a load of their stock had to be put in a bin. So that would be a fantastic example of that as well. The idea that you've got the inventory sat in your accounts currently and something has happened after date, that means that that position you were showing there is not the correct position anymore. So we need to update is the vibe we're going for here. Great stuff. Lots of fantastic examples there. So thank you guys. Okay, small little point here about income tax. You'll likely have covered this when it comes to sort of cash flow adjustments and things already. You just need to be able to calculate physical cash payments of tax. The idea being that you're likely going to have a provision for tax in your accounts, which is likely going to be the amount that you owe to the taxman. This is generally going to be some kind of estimate of your position based on the accounts you've produced. So remember, we are talking about a set of accounts here. We're going to put an estimate of the tax bill that we're expecting in the accounts. However, because this is an estimate, when it comes to actually paying the final tax bill, things may well change. Ideally, we got it bang on the head and everything's perfect, but not always the case. So this will most commonly be linked to sort of your cash flow questions. So yeah, just to touch on what you're asking there, Sarah, it's generally going to be involved within another exercise. We've actually got a question coming up that will touch on tax a little bit as well. So you'll see this in practice in just a little while as well, Sarah. But generally, it's going to be trying to calculate a physical cash payment of tax, or maybe having to calculate the tax liability position, something like that. So yeah, it's all about dealing with this under or over provision rather, put my teeth back in, from previous years. You know, was our estimate too high? Was it too low? Because we're going to need to adjust for any kind of differences there within this latest set of accounts. Okay. Next is a PPE, or your non-current assets, as you may prefer. fixed assets as well. Generally, people are pretty happy with these, so I'm not going to spend too long on how we recognise those fixed assets in themselves. Essentially, you're going to bring in the cost in the first instance, and then you're going to gradually write down that value over a number of years, generally over its useful life. Two different ways we can think about doing that. What are those two ways? Two more common methods that we come across. So yeah, historic cost is, yeah, generally how we're going to bring it in. So depreciation wise, yeah, straight line is one. That would be one of the big ones for sure. And yeah, reducing balance, fantastic. Like to see that in there. Yeah, reference in there as well in terms of impairment. We do touch on that here, but there is another reporting standard all about impairment, so it gets its moment in the spotlight a little bit later on as well. So yeah, great stuff, bringing that up as well. Diminishing balance, yeah, is another way you may refer to it. Reducing balance, diminishing figure. Great stuff. Okay. Talks a little bit about subsequent expenditure. It has to meet certain criteria for it to be brought in as a tangible asset. It needs to sort of enhance the previous asset that you've recognised. It can't simply be repairing it or bringing it back to the condition it was in before. It needs to actively improve it in some way. You know, maybe you're upping the capacity of something. You're making it more efficient. It's doing something better than it did before as a result of this expenditure. If it's simply to get it up and running again, not so much. Can't bring those kind of costs in. So just a small point there. Yeah, we did talk about the initial measurement there itself. Yeah, Sarah, fantastic. You just beat me to it. So great stuff. Love to see that. You've got generally, more often than not, you're going to be using this kind of cost model. That's your bog standard position. Somebody said historic cost before. Absolutely right. Generally, you will recognize your assets at cost in the first instance. And the majority of the time, a lot of businesses will just continue to use that. And they'll just keep rolling forward, depreciate it, maybe do an impairment review if they need to. Revaluation models are particularly useful if the values of certain assets are going to fluctuate wildly or things like that. And we're going to try and carry them at a revalued amount. And we're going to try and do this on an ongoing basis. So as it says here, things that are pretty volatile, changing significantly, and you generally need to make sure that you are reviewing these valuations on an ongoing basis. Land and property is a fantastic example, yeah. Going back a fair while here, back when I was in practice, we used to have various sort of letting agencies and things like that, or businesses that were sort of renting out properties. And yeah, we would have to do, on some of the bigger clients, we would do regular revaluations of those properties. Particularly at the moment, house prices are all over the place. So it makes sense to probably lean towards this revaluation model. In terms of those revaluations, I think the decreases are the easiest ones to get your head around. Pretty straightforward in the first instance. Generally, you're going to bring in an expense. If the value goes down, you reduce the value of the asset. So because it's an asset going down, that's going to be a credit figure. The debit side simply goes to your P&L as a debit item. It goes in as an expense. You go, tough break. We lost a bit of value on that property, so we're going to recognise that expense straight away. End of. The asset value is updated and we just take the hit. When it comes to income, we need to make sure that we use something known as a revaluation surplus, as we've got over here. So we don't just simply add that gain in value and recognise it within our standard turnover. Because especially if we talk about property or something like that, If your property value goes up, it's not like somebody turns up with a check one day and says, here you go, you've just earned 20 grand on your house value going up. It's still kind of that idea of it being a bit of a paper figure. So we don't just want to include it within our standard sales turnover figures. We create what is known as a revaluation surplus. Unrealized profit, I like that, yeah, fantastic. And that income that we spoke about is going to sit within other comprehensive income. Hopefully that's ringing some bells there. So we do just need to be a bit careful with where we recognise that income if we're talking about a revaluation gain here. The good news is if you've had a gain on a property that you then revalue later and it's then made a loss, so we're then talking about a decrease from down here after we've already had an increase, we can remove it from this surplus that's kind of sat in a separate pot first. So that's going to kind of release it. As we say, it's kind of locked away a little bit within a separate pot until we actually sell it and realise that profit, leading on from Sarah's point in the chat box there. So if the value goes down, we're going to remove it from that pot first before taking the hit on, you know, within our sort of profitability on our P&L. So you can avoid it if you've had a gain previously. Okay. Final little point there, we were talking about land and property. Generally speaking, land is not depreciated. Land holds its value particularly well. Generally speaking, the only way it goes is up for the most part. So we don't bother depreciating it for the most part as a standard rule. There we go. Next, we've got leases. This one, you've come in at the right point, those of you that are just sort of starting on this paper. The rules for leases got stripped back a long way from those of you that may have sort of covered this rule previously. Things got a lot more straightforward. Essentially what we do in the case of leases is we bring an asset in. Okay, so even though we don't necessarily physically own that item, we have the right to use that item over a sort of contractual period. So we're going to bring it in as an asset straight away, and we create a liability. Now, does anybody know what value we need to bring that in at, this right of use asset, as we call it here? Any ideas there? Oh, Linda, perfect, love it. Yeah, you're going to have a look at those future lease payments that you are obliged to pay. And yeah, Sarah as well, Sally, along the right lines. Value of total payments, fantastic, Carla, yeah. So you're going to have a look at all the payments that you're going to be making over the life of this lease agreement, and you're going to discount them to present value. Hopefully we're all happy with how that works. But yeah, essentially you're going to strip it back to that present value, and that is the figure that you're going to bring in here as both an asset and a liability. From there, that liability is slowly going to write itself off, and you're going to try and depreciate that asset over a similar period as a general rule to kind of offset those two items. All right. Revenue comes up next. Just here, this is generally, it's going to be quite dependent on the scenario they perhaps give you here. As a general rule, there is this 5-step process that we kind of go through if you're trying to consider revenue and perhaps how much revenue from a particular contract you should be bringing into a set of accounts. This is very closely linked to that accruals concept. Just to give you an example of where this might be important, we've been talking about property. I'm going to go back to it again here. Maybe we've got a construction contract. It's going to take us 3 years to build this particular property. if we, maybe the contract is set up in such a way that we don't receive any money for this construction at all until we finish it and sell it. That is a long time over that 3 years to be recognizing zero income in relation to that work we're doing. So the idea is that we spread it and try and recognize that income as we complete the work. It's kind of the gist of what IFRS 15 is telling us here. So all we're going to do is have a look at the contract, what it's kind of stating, what the expectation of that contract is going in. Try and identify what are known as performance obligations. Often this could be linked to percentage completion as a very straightforward way of sort of trying to come up with that. You determine the overall price and you allocate accordingly. So essentially, if you've done half of the work of the contract, if we know what the value of the overall contract is going to be, we'll bring in 50% of that value as well. Okay, so it's just considering the full contract and trying to sort of recognize it in stages as you go through, making sure you're doing it in a fair way, rather than recognizing it all in sort of spikes. Okay. I think we've got 3 more to go through here, and then we'll get into some questions. We've got intangibles next, and I'm going to be a little bit embarrassed here in the fact that we're recording this because I've got my cheesiest pun ever. Those of you that have been before know that I do love a good cheesy pun, but even by my standards, this is particularly cheesy coming up, so I can only apologise. Intangibles work in much the same way. They're assets that are going to provide value to a business over a number of years. But the key thing is that they have no physical substance. You can't touch it. You can't go and grab it. So you're talking about things like brands, customer lists, perhaps. Customer goodwill is the common one you'll see. You've got research and development down below. Patents, I like that, Justina, very nice. Yeah, fantastic. For the most part, they work in much the same way as your tangible assets do, your standard non-current assets, in that you're going to recognise it in full and then write it off over its useful life. A few little quirky bits and pieces can come into play with them though, and we do come up with that slightly different name for it. Amortization is pretty much the same as depreciation, but just relates to your intangible assets instead. Now, the bit I do just want to get out of the way here is research and development. This is one that they love to pick on in these types of questions. Just remembering that research cannot be capitalized. So we need to know what the difference is between research and development. The two terms generally get lumped in together as R&D up here. Your criteria for something to classify as development expenditure rather than research expenditure is provided in this list below. It needs to be probable. There needs to be an intention to actually finish the project and get it to market. The business needs to have enough resources available in order to get it to market and get it finished. It needs to have the ability to actually use or sell this particular item. It needs to be technically feasible. We can't just say, yeah, it'll probably be fine. I don't know. Yeah, sure, why not? We need to have that sort of backing there to know that this is going to work. And we need to be able to measure the expenditure itself. So the acronym we go to is PIRATE. And if you want a way to remember that acronym, you can just remember that this is the rule that's all to do with R&D. Told you it was cheesy. I can only apologize, but you know, PIRATE isn't necessarily. Oh my, yeah, I think you're right there, EP. It's a bit of a random acronym, so if it helps you remember it, I'm more than happy to make a tit of myself. So what can I say? But there you go. Looks like you got a few giggles out of it. So Yeah, I surprised myself. Well, there you go. Yeah, the sad thing is this recording is going to get sent around to hundreds of people as well. But there you go. We do what we can. You like, yeah, if it helps it stick, it's all good, you know. Okay. Next one we've got are provisions and then contingent assets and contingent liabilities. Slightly different rules if we're looking on the sort of expense side of things compared to the income side of things with these. But there's always sort of an element of unknown with these items. As it says here, a provision is a liability, but we don't know something about either the timing or the amount. In order for us to bring a provision in, you have to have a present obligation as a result of a past event. So essentially, something has happened already that means that there is going to be an obligation to pay something out in future, potentially. Okay. Your next criteria for recognizing a provision is that it needs to be probable. Now, when we say probable, that generally means that it needs to be, I'd say, as a general rule, 75% certain. You know, there needs to be a good chance that this is going to happen before we bring any figures into the accounts. We also need to be actually able to put a number on this. For it to classify as a provision and provide a number in a set of accounts, you need to be able to have a number. You need to be able to estimate it in some way. So if you can't do that reliably, you shouldn't be bringing it in. Okay, so those are your three main rules when it comes to provisions. Okay. It says about obligations, there are two main types of obligation. The most common, the most straightforward at least, is a legal obligation here. You've got some kind of contract that is forcing you to make this payment in the future as a result of this past event. The other thing you've got that is sometimes a bit harder to interpret is the idea of a constructive obligation. Generally, this is, well, the two examples they give you here are perfect, really. It's either past practice, you know, something we've always done, so people would be fairly justified in thinking that you would carry on doing it. There's been nothing to the contrary to say that you're going to stop doing it. So you could classify that as a constructive obligation. The other one is published policies. You know, if you're advertising in the media that you offer extended warranties for free, even if that's not included within an actual signed contract, if you're actively promoting that as a selling point, you can't then turn around and say, well, actually, we didn't put that in the contract that you signed. You've still created that constructive obligation instead. Okay. If it fails on one of these, oh, there we go, Sarah, perfect example. They offer a 2-year warranty. This is John Lewis. Legally, they only have to offer the 1-year warranty. Yeah, so, you know, there's a good chance that they would include that within some kind of small print somewhere, perhaps. But if it isn't, if they're actively advertising it, they're going to have to uphold that. So yeah, I like that a lot, Sarah. PLC, is price match included? Yeah, again, but it may well actually be physically written into some kind of small print somewhere. I know adverts are fantastic at this, of having the really tiny writing right down at the bottom that nobody can read quick enough before it's off screen again. But the fact that they're actively advertising creates that constructive obligation, even if there isn't that legal one. So yeah, absolutely. If we're not going to bring in a provision, doesn't mean we just ignore it altogether. We have these contingent items that pop up down here. They're along a similar sort of lines in that generally this is just a disclosure. In some way, we're just going to make sure that we tell people about this particular thing. When we're talking about contingent liabilities, generally you're considering this being possible. So as soon as it drops under that 50% threshold here, it's going to fail on that sort of probable threshold that we had up at the top. Or if it becomes uncertain in one of the, it fails on one of these other criteria, maybe we just don't have an estimate for that particular thing. Doesn't mean we shouldn't tell people about it. So we're just going to stick a note in instead, just to be like, by the way, just to make you aware, you should know about this going forward. So yeah, simply all we're going to do is disclose this in our notes. We're not bringing any actual figures in. When it comes to contingent assets, it's much the same thing. We're simply going to disclose, but the threshold for this to go in there is slightly higher. Generally with your contingent assets, you're going to be looking at this probable threshold that we spoke about up here before we even talk about these things in your accounts. So yeah, again, generally just a brief description. Sally, would a question ever say 50% likelihood so you have to make the call, or would they always be definitely over or under? I would say, as a short rule, they tend to be fairly obvious. Yeah, they do tend to try and spell it out as much as possible. Depends how mean the examiner is feeling on that one, I think, Sally. So it depends if you catch them on a bad day, I think. As a general rule, they'll generally make it pretty obvious. They're not trying to catch you out. They're just trying to make sure you understand how the rules work. Yeah, I like that a lot, Sarah. Yeah, they do tend to just stick to the wording that we've just gone through in terms of possible and probable, rather than using percentages as such. Because one person's possible and probable, how do you assign a percentage likelihood to a lot of things anyway? Can be tricky. So yeah, they would tend to use the wording a lot more, as Sarah says. Okay, final point here is to do with impairment. We've kind of touched on this already when we've spoken about fixed assets. This is generally in terms of value going down, and it comes back to that thing we spoke about in the inventory section, in that we don't want to overstate our assets. We don't want that figure in our accounts to be a lot higher than it truly is. So generally what we're going to be looking at is there needs to be some kind of event, some kind of trigger that's going to lead to an impairment review. Generally this could be something gets damaged in the warehouse, or it becomes a bit of a diminishing product, or it's a bit obsolete perhaps, and its value has dropped in the market. There's some reason to think that this particular item does not have as much value as it once had. So all we're going to do is consider that and see what we think. Generally, that involves considering some of these terms that we've got here. So the first thing we're going to talk about is fair value. So that is essentially what we could get for it if we took it to the open market right now. What we could essentially get for it if we were to flog it as of right now rather than keeping it. What is its market value is generally what this fair value figure is going to be. What you need to think about is if there are any selling costs that are going to go alongside that as well. So you may be able to get, let's say, £2,000 for selling off a bit of plant and equipment that got damaged in its current state. But in order to make that sale, we're going to have to list it somewhere, maybe go through like an auction and pay some fees of some kind. We're going to pay 500 quid. So in terms of the recoverable amount that we're getting back from it, we're talking about £1,500 rather than that full market price. So something just to consider there. The other side of the coin is to talk about the value in use. Essentially, what could we get out of this particular item if we just held on to it? It's going to generate some kind of value. It might not be as much as it once was, but it may have some value. So that's value in use. Does what it says on the tin with that one. So to determine what our recoverable amount is, we simply need to pick the higher. Let me just change color here so it stands out. It is the higher of your value in use figure and that fair value less any costs to sell. Essentially, when you're looking at recoverable amount, you've got to make the decision of whether to keep or sell this particular item. And since you're going to get some money out of it, you're going to pick whichever one is higher, right? If it makes more money by keeping that particular item, that would be the option you chose. If it's going to not generate all that much if we kept it, but if we flog it right now, we can turn a nice little profit on it, you'd do that instead, right? Think about it logically from that position of, do we keep it, do we sell it? And you pick whichever one is higher for that recoverable amount. From there, all you're going to do is compare that figure to what you have in your accounts. If your recoverable amount is higher than the value in your accounts, don't need to worry about it. There's no impairment there. The value in the accounts, you're not overstating it, so it's not a problem. We only worry about it if this recoverable amount is lower than the figure in the accounts. It means that the figure in the accounts is too high. We're painting a better picture than it perhaps is, and we bring it down. Yeah, so it is kind of a revaluation. It's a similar sort of line as a negative revaluation there, Linda. Yeah, absolutely. Your adjustment that you're looking at works in much the same way as a revaluation would, except we're just going to, it may get put into a slightly different code on your statement of profit or loss because it will be recognized as an impairment expense. Okay. Whereas we said revaluation, sometimes you have to mess around with those reserves and things. Because impairments are generally going down, it's always just going to be a case of shifting it across to your expenses. So yeah, you simply reduce your asset value to whatever that recoverable amount was and expense the rest. Job done. Okay. Yeah, one small little point that they could potentially pick on, they don't tend to pick on it in this section of the paper, but it could be done elsewhere. From that point, you consider, now we've adjusted the value of that asset, we consider its life going forward, and you would amortize or depreciate this accordingly. So having adjusted the value of this thing, we might say it's now got 3 years left as opposed to the 5 we would have thought it had originally. You would depreciate based on that new position. Okay. But generally, you just need to know that you need to update the asset value as a general rule in this part of the paper. All right, are there any questions at this stage here, or are we fairly happy to move into some questions? I know I've taken up a good chunk of time already there, so quite keen to get into some actual tasks here if we're happy to do so. So I've just had a private message coming in asking if we're going to send out any explanations of this. You will actually get this full recording here, Julie. So you will get all my descriptions and explanation of this sent out to you in the next few hours. So yeah, once the session wraps up, you should get that. It'll be sent to whatever email address you registered, you signed up with. Looking forward to questions. Wow. Okay. Hope I don't disappoint, Sarah. We will dig into it. Okay. So we're going. You should hopefully have had these sent out if you were signed up from last week's session. I think Christina sent these around to you all. If not, just follow through on screen. We'll go through it all in full now. Annoyingly, for whatever reason, when we've exported this, it's changed these parts of the question to C, D, and E, and then it refers to A, B, and C in the solutions here. Don't worry too much. It is just the 3 parts that we're working through on this task. The first part is asking about an impairment test, when it should be carried out, and what we're trying to do within an impairment test. That's all the stuff we've kind of just covered. your key rules are you test when something has happened that triggers you. Well, you have reason to believe that the value might be too high within your accounts. So you just consider what the value actually is, and then we're going to reduce it as necessary. So yeah, that's kind of what we've just been discussing anyway. So I'm going to go straight into parts B and C here, if that's okay, in the interests of time. We have two bits of machinery here, machine 1 and machine 2. Shocker, inventively named there. And we need to decide whether we need to adjust for either of these bits of machinery. So machine 1, we've had it for a while. It's been here for 6 years. The carrying amount in the account is 14,500. It's not been used for 8 months. The business has gone out and bought new machines, and it's not expected to be used again. If this machine was to be sold, we could sell it for £3,800, but we'd have to advertise it in order to sell it, and that would cost 400. So what do we think here? The first question really is there some kind of trigger here to make us think that that value could be an issue? What would your indicator here be if there was one? Do we need to do an exercise here? Yeah, absolutely. Deborah, Sarah, Linda, plenty of good answers coming in. Yeah, we're not using it. It's valued at 14.5 grand in our accounts, and we're not actually using the thing. So that seems odd. So we should, at the very least, have a look into this and see what we think. So that's going to be your trigger. So for our impairment exercise to go ahead, we need those 3 figures. We've been given one straight away. We know what the figure is in the accounts. It's currently included at 14,500. Sarah, yeah, compare carrying value. Lovely. And we're going to need to work out what the recoverable amount is. That's that decision of if we were to, consider what we're going to do with the asset. Do we keep it or do we sell it? Those are your 2 options. So first part to consider for recoverable value is going to be, I'm going to go for the easy one first. Oh, I like that calculation though, Nelly. I'll come back to you in a second on that one. I'm actually going to go back to Sarah's, not Sarah, sorry, it was Sally, saying about the value in use. That was the idea. If we keep this item, how much is it going to generate us? Well, we're not going to use it anymore. We're not planning to use this thing going forward. So if I just split this in half here, if we talk about machine 1 on this side here, its value in use is absolutely nothing. It's got no value in use because it's just going to be start gathering dust somewhere. So yeah, no value in use whatsoever. The other side of things if we're not going to keep it, we may as well sell it. What can we get for selling it? So we go back to our scenario here. I'm trying to find a colour that I've not used. That's not one of them. So we said the selling price was 3,800, but we need to place an advert with a cost of £400. So the benefit that we would get out of this, remember it's fair value less any cost to sell. So fair value less costs is going to be that 3,800 less the 400. So we're talking about 3,400. Fantastic. Those were the 2 figures we needed to work out what our recoverable value here was going to be. Which of those 2 figures are we going to choose? Do we take the nil? Do we take the 3,400? Do we want to do anything else with it? Yeah, it sounds like people are a bit of a consensus there, going for that fair value figure. We take the bigger one of the 2. So you think about it from the business's perspective here. What would you choose to do? And you're going to want to just get rid of it because you're not going to use it. You may as well sell it. All we do from here is compare that to the carrying value in the account, which we've already been given, and you can see that it's a lot lower. So if I just bring that in just for the sake of completeness here, we know the carrying value is 14,500. Sarah saves me from having to embarrass myself with a bit of basic maths on the spot. Good stuff, like that a lot. We take the difference between these two figures because our figure in the account is way too high. Oh, that's a highlighter. I mean, you can still read that. I'm going to carry on. There we go. And you're going to be impairing by 11,100. As Sarah says, fantastic. We need to reduce that figure in the account. I'm actually going to roll part C into this while we're at it. How would you post that? What is your journal going to look like here in order to correct that? Nice, Nelly saying we're going to debit impairment. I like that. And we're going to credit the asset itself. Sarah's beating me to the next question. I was about to ask, yeah, which statements do these things pop up on? Yeah, the impairment is an expense. So that is going to come up on your statement of profit and loss. And your asset here goes onto your statement of financial position. So yeah, essentially, you're going to be posting that 11,100 to both of these parts. That's going to reduce the 14,500 that you've already got sat in your assets and bring it down to that figure that we want to have going forward. Perfect. Machine 2 is next. Makes sense to go on to machine 2 after machine 1. So we're going to start out with exactly the same consideration. We need to work out what our value in use is going to be and what our fair value less costs is. I've kind of skipped a step there actually, sorry, getting ahead of myself. We need to consider if there's an indicator here. So let's read through our scenario. Machine 2 was purchased only 1 year ago. £15,000 depreciated on a straight line over 4 years. Okay, fine. We might have to do some calculations here. Hasn't given us a straight carrying amount in this case. But anyway, the machine's in good working order, but a delivery truck has managed to ram into it or something and has now damaged it. It's been repaired, but it's impacted on its future revenue generation. Yeah, absolutely. That is your stereotypical indicator of impairment. Not only has there been damage to it, we actively know that its output has been affected by that damage. So yeah, we should absolutely be doing this check here. All right. Starting point then, our two figures. Does anybody want to start me off? What can you give me either of the two? We need value in use or fair value less costs based on this scenario. Any suggestions? A lot of people jumping in on the fair value one there. I like that, yeah. Get the easy points out of the way early. It actually tells us that this is a specialized machine. We can't sell it. So by that logic, it's got no fair value. I mean, we can worry about costs to try and sell it if we want to, but we're not getting any profit out of it. So yeah, absolutely. Your fair value less costs is going to be nil here as well. So that's not good news. Plenty of people popping up there. Value in use. Again, yeah, they've given this straight to us. We know that it's going to generate 6K. So we can bring that straight in as well. Good stuff. So again, I won't force you to shout at me with this one. We're going to pick the higher of the two, going back to what we did on machine 1. So we're going to pick the 6K this time. Thinking of it from a business perspective, you're not going to sell something that you can't sell. So we're going to keep it instead. I did see flying past in the chat box our next step, and I believe the calculation was correct. It's now flown by, so apologies. I believe it was Nelly who got there, so well done. But we need to then have a look at this carrying value. This time around, they didn't give it to us straight away. They did tell us that we bought it for 15,000 and we're doing straight line depreciation over 4 years, and we've had it for 1. Linda there with the calculation as well, looks good to me. We know that the cost was 15,000. We're depreciating this over 4 years, so I'm just going to divide by 4. So I know that the depreciation is 3,750 per year. So we therefore know that the carrying value is going to be the 15k less that depreciation, because we've only got 1 year's worth of depreciation to worry about, leaving us with 11,250 as our carrying value in this case. Cracking stuff. So yeah, it looks like your figures are good there as well, Sarah. Great stuff. We're all on board. Like it. So final step, PLC, getting ahead of us again. I like it though, good numbers, shows you've got to the right point. Yeah, absolutely. You're just going to compare the difference between the two. And once again, this is the figure we've got in our accounts. It's too high. We need to reduce it. So this time round, we're going to need to impair once again. This time the difference is 5,250. And your journal's going to look exactly the same, just update the amount down here. So, you know, you could potentially combine those into one journal and do this as one big impairment exercise if you like. Similarly, you could just do 2 separate journals, but both of them will be expense to the P&L and reduce the value of your assets overall. It will, Dan. Yeah, no problem at all. I realise we've hit the hour mark. I am planning on going through the task 5 one briefly as well. Should be a bit quicker than this one, but if people are needing to head off, please do feel free. The recording will come around to everybody, so you can follow up on anything you miss beyond this point if you like. But yeah, if you're happy to stick around, I'll appreciate the company. Saves me talking to myself. But there we go. That is task 4. As you've seen with the task 4 questions, these ones will generally take one standard and do quite a detailed scenario that relates purely to one of those standards. Tends to stick to, you know, one. It might touch on the second one. You know, you can see a question where they talk about fixed assets in the first place and then move on to impairment later on, perhaps. But yeah, it's kind of a more detailed approach to one particular standard. That is the problem, Sarah. Yeah, there are a whole bunch they can choose from, for sure. Any standards that are most common for this task? Afraid not. I mean, you can play guessing games with this one. They do like impairment and fixed. I mean, when you're talking about assets, there's a lot of different standards that they can pick on in relation to those assets. So you could go down that path, but potentially they've gone across the board with these things. And you are going to need these in the other areas of the paper as well. So, you know, a bit of practice of all of them isn't going to hurt you in the long run anyway. So as much as it's a cop-out answer, the more questions you see, the better prepared you'll be for these ones in particular. I think some lend themselves better to the question, but probably wouldn't rely on it. Yeah, I mean, a good example of this would be that tax standard that we went through. They're going to struggle to actually be able to pull out the full mark allocation here. Remember, they've got to somehow drag this out. I thought that was going to be a quick scroll there. But yeah, they've got to get 12 marks worth of content out of this. There's not a whole lot of filler they can put in there to flesh that out to 12 marks. It's not to say they couldn't roll it in to a task here. So do just be careful with like discounting certain ones. Because like I say, we're going to move on to a task 5 question that touches on a lot of them. So yeah, you're going to need the knowledge anyway. Right, so here we go. Task 5 comes up next. You saw with task 4, very much focused on generally a single standard. Might touch on a couple perhaps if they're feeling a bit frisky with it. When it comes to task 5, they're generally going to touch on a lot of them. Task 4 was often kind of a bit more free flowing. You saw there, they give you it's going to be humanly marked. They're going to want you to discuss how you would approach certain things, do a few calculations, and you know, sort of what you've just seen basically. When it comes to task 5, however, they're going to be covering a lot of different standards. They're going to come at you thick and fast. And that's because you've generally got a true or false question and then a load of multiple choice. And they're going to jump around different standards and give you some little quick bits of scenario that they expect you to work through. Okay, so we do just need to be thinking on our feet with these ones. So we're going to jump straight in. As I say, the content that's going to come up in here is exactly the same as the stuff we just went through. So we can jump straight in. Task 5, example 1, talks about Fables Limited in the first instance here. They have a machine bought a number of years ago, 15,000, now has a carrying amount of 8.5. There is a fire at the factory. This is fairly recent. Number of items were damaged. This particular machine suffered slight damage, and as a result, it would only fetch 3,000 if it was sold. The machine is still in good working order, will continue to be used in operations for the next 5 years, where it generates in excess of 9K. What do we think? Do we need to tweak its value? We've got a couple of falses there. Are we in agreement, guys? Does anybody want to buck the trend and go true? Does anybody want to expand on the false? Why are you going for false here? Any takers? What's wrong with it? Perfect. Yeah, you do that recoverable amount exercise. It would only sell for 3,000, but it's going to generate in excess of 9. So it doesn't tell us the exact figure, but we know it's over 9. So from that recoverable amount exercise, you pick the higher of the two. So you take the 9, you compare it to the 8.5. The figure in the account is less than that recoverable amount. So yeah, absolutely. Yeah, future income higher, perfect. Value in use is higher, spot on. So yeah, we definitely, you know, it was definitely worth going through that exercise. You know, there was that trigger there was that damage to it. But yeah, don't need to tweak it. It's fine. Fine as is. Next, we move on to intangible assets. Which of the following can be capitalized according to this standard? So we start off with a couple of goodwill items. We've got purchased and internally generated. Do we like either of those? Purchased only, absolutely. Yeah, the big reason that internally generated goodwill falls down is that it's hard to assign a value to it. As soon as somebody is willing to put the money where their mouth is, you can kind of work out a reliable value for it. So that's why we need that purchase goodwill only. Playing, you get a question on this on your exam tomorrow. Good stuff. Hopefully the rest of this stays that way. Yeah, best of luck. I'm sure you'll be fine. I'll keep everything crossed for you. Any others on that list that we're going to bring in? Licenses. I like licenses. Yeah, we can bring those in. They're going to have a benefit to us for a number of years. Let's throw those in. Development. Lots of people there with development saying it meets pirate. Yeah, think about me making an absolute tit of myself. Yeah, good stuff. We'll get that in there. Yeah, definitely needs to meet that criteria. Tells us that it does here. So we're all good. Patents as well. I would agree with that one. Again, they're your stereotypical intangible assets. Let's throw those in as well. You're all right to say research is a no-go. We've done quite a lot of detail on R&D already, so I won't go into too much more on that. Staff doesn't really count because, well, I'll leave it to you guys. Why are we not counting staff here? They're highly skilled and experienced, so they're, you know, it's going to be useful to you as a business. That's the big one. Yeah, PLC, Sarah. Oh, EP, ruthless, replaceable. Yeah, Carla. Yeah, they don't. You don't own them. They're not. People often say that your employees are your biggest asset as a business, but yeah, the idea being that the big one, like you say, is they can just walk out the door. They can hand their notice in and leave, and then that's simply gone. Yeah, customer list is a fun one. I did describe it as an intangible item earlier, but we are going to be leaving this one unticked. And yeah, Linda and Sarah there with the big reasons why. Generally, it's very hard to put a measure on what benefit that will have to the business. It's definitely useful, but it falls on the same criteria that this internally generated goodwill does. Coming up with an accurate valuation for that is particularly tricky. Oh wow, I like that. So basically they've got insurance if somebody decides to walk. I didn't even know that was a thing, Deborah. That's cool. I like that. It makes a lot of sense if he's particularly crucial to it. So yeah, there you go. I like that. I might steal that one going forward, Deborah. That's cool. Okay. We've got a scenario here. This is one that's going to link us back to cash flow statements and that kind of train of thought. It's talking about operating activities here. We've basically got a bit of movements here, and it's not very clear on this one, but this is essentially our current position in this column, and this is the previous period. And we've got the movements. It's just come straight from the accounts, maybe a draft set or something. Inventories, receivables, payables, and how they've moved in the period. It then tells us some extra info, and I'm going to start jotting this stuff down as we go through. So our starting point here is the profit from operations for the year is 14,520. So I'm going to write that down as my starting point. I'm going to do it over on this sheet just to give myself a little bit more room, save me trying to cramp it into some margin or something like that. 14,520. Good starting point here if we're trying to work out how much cash we've generated. Any adjustments that we can pick out from that that task there? I'm going to leave you guys just to have a minute or so just to pick through, see which ones you can pick out. Anything we want to tweak from there? Just pick through. Yeah, PLC starting us up nicely. The movement in these three things up here are definitely going to need to be adjusted for. I'm actually going to save those ones till the end here because these are the ones that take a little bit more thinking about, I think, generally. But great stuff. Definitely need to adjust for those. Non-cash expenses appearing in there. Yeah, they're non-cash items, so let's get them out of there straight away. Depreciation doesn't want to be in there either. It's a paper figure. It's made up. Get it out. Loss on disposal of 2,000. Once again, yeah, bit of nonsense. We don't need it in there. No interest to worry about. Yeah, that's definitely good to know. So we don't need to mess around with that. And this is where that tax bit comes in. So nobody's tackled the tax one yet, but there is something going on here. It tells us that the tax charge in the statement of profit and loss is 3,800. No opening tax balance. The liability at the end of the year is 200. Yeah, golden, perfect. We're going to need to work out the tax that we've actually paid. So we know that we've expensed 3,800. We weren't expecting a liability, but there must have been something, because we've only got a liability here at the end of 200. So the liability, the estimate we're bringing in for the current year is 200 quid. So we need to see what we've actually ended up paying for the previous year. And yeah, a couple of answers coming in already. Great stuff here. We're going to take that 3,800 that we've expensed. Take out the 200 that's still outstanding. So we're looking at actual tax paid in the period of 3,600. Is everybody happy with that calculation? It does tend to cause some headaches. Essentially what we're saying is we've recognised £3,800 worth of expenses in the accounts this year. Only 200 of that relates to stuff that we need to pay going forward. So the difference must be a tax payment relating to previous periods. Good stuff. Okay, we're all happy with that. So I'm just going to bring in all of those totals in this info down here before we tackle the SFP stuff at the top. So we've got, oh, leaning on buttons, shouldn't be doing that. Non-cash, it says this was a deduction, so we're going to need to add it back onto the profit. It's an expense, so it would have reduced the starting figure we've got. So we're going to add it on. So that's 4,200 with that one. Depreciation comes in next, which is 5,050. And we had the loss on disposal, which was 2,000. Again, a loss is going to be an expense, so we need to add it back on. Nothing to worry about in terms of interest. We've worked out the tax paid as well, so I'll get that into my big sum up here. 3,600. This one is going to actually come off of that total though, because that figure was not included in the profit. Remember, this was the profit, if I go back to the example here, profit from operations. So we need to remove that extra, that extra cash payment that will not be wrapped up in that figure. So yeah, absolutely. So that's everything from the wordy stuff. Let's have a look at this table. We've got some answers coming in. Let's work through them one by one and see if we all agree with Nelly. Looks like Sarah agrees as well. So let's see what the rest of us think as well. Inventory first. The way I'm going to tell you to go through this is generally to think about your cash position. Is the movement in these things going to help you out or make it worse? So if I just start a column over here for the difference in the two, the difference is 411. Is the fact that our inventory figure has gone up going to help our cash position or make it worse? So many people in the chat already telling me it's a negative figure. It's making it worse. Yeah, absolutely right. Basically that, yeah, perfect, PLC. Cash is tied up in those inventory items. So this has gone up, which is bad when we think about cash flow. We've got money tied up in these items. So yeah, absolutely. Come back to my calculation. Inventory, movement in inventory, if you want the full title here. 411. Similar lines, trade receivables, our difference is 432. This has gone down. So is that good or bad for cash flow? Yeah, nice one. We're not waiting on customers paying us as much money as we were before. So less of that money is tied up in those customer balances. So that's good. Nice. So receivables. Apologies for my scroll here. Try not to keep you too much longer because I'm aware we've already well and truly run over here. But 432, stick that back on. Final one is 33 difference. If you run that through a calculator, the payables figure rather has increased. Add that back on. Yeah, again, that is also a good thing. You can think about it just as the opposite of receivables. If you can get your head around one or the other, they're the opposite of each other. The other way is, yeah, we've taken advantage of more credit terms. So we've not actively paid anyone. So yeah, we've actually got 33 quid that's in our pocket rather than our suppliers. 33. Yeah, great. I'm loving the commentary in here as well. The reasoning is fantastic. It's great to see that as we go through. All absolutely correct from what I've seen so far. So good stuff. If you tot all of that up, it should bring you out at a figure of 22,224. Hannah, spot on. I like it. Yeah, perfect answer. It's the middle option in here, and we can move on from this big monstrous calculation I've got on the other page. Yeah, awesome. Okay. Quick one here on inventories here. What's the rule when it comes to inventories? What is it we need to remember? Lower of cost or net realizable value. And Hannah saying tackle it on a line by line basis. Perfect. Yeah, couldn't have put it better myself. How many marks would that have been worth? Somebody asked in the chat box there. They'd certainly have to give you more for that one compared to the earlier parts. Generally, your multiple choice question, like your true or false things, are going to give you a couple of marks as a general rule. So we've got, you know, another couple of multiple choice ones down here. So you got 6, maybe 3 here, maybe 4 or something like that for this one, I guess. If I was to have a stab at it, it's going to be sort of 3 or 4, perhaps, maybe even 5 if you're lucky. The thing I would urge you to do is, if you are against the clock here, pick up your easy marks early. Those multiple choice ones where it's just a bit of theory, you can answer very quickly. If you're going to have to do big, long workings and you are really against it, maybe move on to a different one and come back to this. The other thing is, you're obviously going to save a bit of time on those short questions as well. So if you overrun a little bit on this one, it's not the end of the world. But yeah, absolutely. When it comes to inventory, we need to work out cost. We need to work out net realizable value. To get to net realizable value, however, we're going to need to consider the selling price less any costs. And they've given us the selling costs in total. So we're going to have to kind of scale that up to an overall amount in order to work this out. We can't really do it on a, I mean, we could potentially scale this down to a per unit basis if you like, but the numbers could get a little bit messy. So I'm going to scale it up to overall totals for these items. So we'll go through the cost ones first. It's simply a case of multiplying the number of units by the cost per unit, which should bring you out at 4,250, 540, 300, and 760. Hopefully, if you've tackled this question ahead of time, you agree with those figures. It may well be me getting them wrong when I did it earlier. So please do feel free to correct me if you don't agree with that. A couple agree. I think I'm all right. Good stuff. Always a bonus. Okay. I'm going to change color just so it doesn't get confused with my workings or anything. I'm going to scale up the selling price and then take off the selling cost. So if I multiply through my selling prices, as I've just done before, you get 4,650. What the hell's happened there? We'll try again. There we go, 4,650, 750, 425, 2,200. And then you remove those selling costs, which should bring you out at net realisable value. So I can see a few popping up. 4,000, 550, 350, and 700. Let's just check the figures I've got on my chat box. Linda and Sarah, spot on. Hopefully everybody can follow where I've pulled those numbers from. Please do let me know if you're struggling to follow the workings there, but just to whiz through this a little bit faster, hopefully you're all on board with that. From here, go through that line by line basis, and you're picking the lower of these two figures, the lower of cost and net realisable value. So we go bam, 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 and bam. Just go down each line, compare the two figures, pick the smallest one, and when you add them all together, those of you in the chat box saying 5,540, you're absolutely right. Well done. Good stuff. Nice one. Everybody happy with that? Please do pull me up if I've lost you at any point. Just a couple more, and then I promise I will let you get on with the rest of your evening. Apologies for going so far over here. Couple of quick theory questions to go through. We've got events after the reporting period for our penultimate question here. Company year end is the 31st of December, and we need to decide which two of these four scenarios we would need to adjust the financial statements for. So we'll just go through them one by one and decide if we like them or not. Dividend proposed on the 1st of January 20x5. No way. One, it's only proposed, and two, it's after date anyway, right? So yeah, absolutely, we're ignoring that. That's no good at all. You know, there's no pre-existing condition there. Nothing in our period that would relate to that. So no good. We're leaving that one alone. Second one, a letter is received on the 8th of January stating that a customer owes us some money and they've gone out of business. For sure, this is your stereotypical one, business in liquidation. It doesn't actively tell us that that 10,000 was existing in the year end, but the implication is there, I think. So yeah, it definitely seems fine. Pre-existing condition is the debt. We now know, based on some after-date information, that that's not going to happen. So we should be getting rid of that from the accounts. Nice. Number 3, January, there's a fire, damages the equipment. It's going to lose 2 months of operation. It's going to close. They're going to repair. They're going to get significant losses. The assets are insured though. What do we think to that? Ryan adamantly saying no. Why not? What's the big problem? Fire is generally one of those that comes up a lot of the time as an adjusting event. What's the big problem? What makes you say no to that one? Future expense, year end was correct. I think Sarah and Sally, I think that's the biggest one of them all. It says it's going to have to close going forward. Yeah, I agree. That's kind of a future problem. It's not anything that related to the previous period. It says about significant losses. The big one, I think, for me, is the fact that it's insured. They should get some money back for this. It's not going to be a going concern issue. So, yeah, no. I mean, it might be worth making a disclosure about it if you really wanted to, but no, absolutely not. We do not need to go back and adjust for this. So yeah, no, I'm more than happy for that. That adamant no from before definitely is the way to go here. That leaves us with 4, being the final point here. Court case. In the accounts, we didn't know what the likely outcome was. We now know after date. So yeah, the pre-existing condition is there. The case was ongoing. It's already happened in the accounting year. Ryan with the yes. I can't really do it. I can't do that one unless I sound like a snake. But Yeah, we get a bit more info. So now we have that measurable figure, we can reflect it in the accounts. Yeah, absolutely. Bish, bash, bosh. Final one then, hopefully we'll get wrapped up just before the half-past mark. We're looking at leases. How should a lease be initially recognised in the lessee's statement of financial position? We did talk about this one earlier. Let's see if we remembered all the way back to the start of the session here. Nice one. Nobody falling for the red herrings that are on screen. It's the present value of those future payments. Perfectly done, guys. Loads of right answers in the chat box. Always nice to see. So thank you very much. Shows you were paying attention to me at the start as well, which is always nice. Either that or you knew it anyway. Could go either way on that one. There you have it. That's a task 4 and a task 5 question gone through there. Can we do a task 4 written question on leases in a few weeks' time? I can absolutely. It may not be me doing it again by the time we come back around to task 4 sessions there, Sarah, but I will absolutely pass that message on. So whoever is taking it, it may well be me. I'm not sure how it quite pans out just yet. But yeah, I'll make sure that message gets passed on. I'll jot that down now and make sure it happens. Now, I'm glad it was useful, PLC. No worries at all, Linda. Glad it was useful. I will stop the recording there. I will get that sent around to everybody as well. If you do have any extra questions, though, please do stick around. I can hang around for a bit and help you out if you've got any other questions. But I will stop the recording there before we go on too long.